Welcome back to the Always Thinking Mindset channel, where we give you positive vibes and simple rules to achieve your goals. Now, in today's video, we're going to discuss on what are the three main reasons to invest in index funds. Now, what the heck is an index fund? But before we begin, if you like today's video, go ahead and give it a thumbs up. It does help the algorithm. And if you love this channel, then you already know what to do. No subscription necessary. Please stay tuned. Now, the first question is, what is an index fund, right? And it has to do with the stock market, right? It's stock market is one of those things that certain people they know how to understand the lingo, look out for risks, but it's just one big gambling casino, and you're just expecting a return to break it down for you. But an index fund, the first rule I want to start off with is diversification. What does this mean? You just play the market and you spread it out. And anybody that gambles, not that I condone, I condone gambling, but anybody that gambles understands once you spread it out, you're able to get more wins. Sometimes a little bit, you kind of break even, but you're able to get some of that money back. And the point of an index fund is to invest, get some money back, dividend, but you're playing the market. No one knows the market. I hate when a lot of pundits out there that say this is what's going to happen this year and next year, and no one has a crystal ball. Okay, let me start there. But at the same time, you got to understand the stock market has been around for a while. If you study it, you can kind of see the patterns of it. But you can never go wrong with index funds. And index funds, they usually just spread across the board. It's a little piece of everything. And the most common one is the S&P 500. There's also the Dow Jones, and it's just sort of like a basket of stocks. And they kind of play the market, and they just, sometimes you take a hit, sometimes you actually make money. But playing the market it's not like an overnight thing, right? You have to do this long-term growth, but the fact that with an index fund, you're not just targeting a certain stock, right? You're not throwing in all your chips on one stock hoping it's going to sink or swim. Index funds, you're spread out, you get to diversify. And with, years, even Warren Buffett said he just played the most average stock market price, and look where he's at now. But that is the first rule. The second rule I wanted to get to was with index funds, low fees. So what does this mean? Because you're playing the index kind of like a default of the stock market, you don't have this fancy schmancy manager here, right? To actually sit across the board, even though we're all thinking, they're right, they're back there just working on your stock and your stock only, which they're not. But yeah, you're not you don't have this fancy manager, so you don't have to pay him as much. Usually, it's low cost, low fee. I think it's like 0.1% to actually passively manage this. It's just pretty much getting your money that's in the basket, spreading it out, making sure it's going, through quarters, quarter one, two, three, four, but just through the lifetime, right? Whether it's 5 years, 10 years to 15, 20 years. But yeah, the fact that with index funds, you're able to spread, diversify, but the costs are low. So when you have low costs, that's more money in your pocket, which is more money you can invest and just rinse and repeat. That's all you have to do, right? And it's not that it's hard, it's just the discipline behind it of you reinvesting. That's the hard part because of course, anybody that wants to make money wants to go out and spend it. But if you can reinvest it, then you're on the right track. Which leads me to my third and last rule, which is the most important, that with index funds, this is long-term growth, right? I don't want to disappoint anybody because a lot of this technology that we have, they want instant returns and instant gratification. But listen, the stock market's been there forever. With the S&P 500, it's usually like buying stocks from other companies, and some fail, some succeed. But at the same time, you're going to get a return through time, right? And whether you have Amazon, Netflix, can you imagine if you had all this and you had a crystal ball and, boom, you landed the dart on the board? Of course, we'll all be mega rich, but nobody knew that. Nobody knows what's happening. But if you spread it out and you're able to acquire a little bit of everything, then you can't go wrong, right? And with long-term growth, the S&P, their return is usually about 7 to 10%. And even Warren Buffett said, give me 10 years, and I'll play the standard. Everybody wants to play against the market, but if with index funds, it kind of does it for you. It's like the default. And you can't go wrong with that, especially investing, your money in there. It's a safe alternative other than your 401k and other investments, but that's what an index fund is, right? It's not hard. It's not supposed to be complicated. It's just, mitigating risk, monitoring, and just want exponential growth, but not overnight. And at the same time, you just have to keep pumping money into the machine. Now, with that being set aside, Bitcoin. Bitcoin is one of those things that, listen, guy, you're either going to catch on or not. you know, we're kind of in a trend right now, even though there's a bill being passed, but Bitcoin to me it's fluff, right? It's very volatile. It doesn't have any assets back it up. It's a currency. I mean, to me, I don't know. It would have caught on already. That's the way I feel about it. But anyways, with index funds, you can never go wrong. Obviously, the stock market is strong depending on the era and where you're at, because even somebody's low point might be the high point of 20 years ago. So you got to look at the range, the graphs. You got to learn how to mitigate risks. But on top of that, index funds is one of those things that you can't go wrong with. And at the same time, it doesn't hurt, right? Because let's say you get the average of 7 to 10%, at least you're investing compared to somebody who's just zero, right? Ends up with zero. But if you like today's video, go ahead and give it a thumbs up. If you got value from today's video, give it a thumbs up. Let me know what you think on the comments below. Like I said, index funds are one of these things that you don't have to be this super genius guy. You just have to keep pumping money in there. But a disclaimer, which I did not say, please don't take anything I say in this video as financial or legal advice. But, consult with a professional or any kind of tax strategist or even stock, manager, whatever. Don't listen to a guy on the internet. But at the same time, until next time, folks, we will speak soon.